Now we come to the part of the show where I talk about what I believe is important for individual investors to consider before you make your investment decisions over the next couple of weeks. As always, we have three topics, and look at that. The Fed is actually not one of the topics. I know we've had Fed speak on as a topic for a number of shows in a row. However, we do have U.S. Treasury bonds, which we just spoke to Brian about. The rise in interest rates, government bond rates in the U.S. predominantly, how they affect the market. Number two would be look for a change in tone of the markets. October tends to be that month where things come in negative, but there's a change mid-month and come out of the month a lot more positive, and November tends to be one of the more positive months of the year. Third, corporate earnings. Corporate earnings season will begin in the next week to 10 days. Really, I say that corporate earnings season doesn't kick off until the U.S. banks start to report earnings. And we'll talk a bit about the two biggest banks in the United States, which will report first, JP Morgan, Bank of America, along with other large banks like Citigroup, Goldman Sachs, Morgan Stanley, et cetera. But overall, the corporate earnings season, at least the start of it, will go a long way as to tell us, the state of the U.S. economy and the state of the economy as a whole. So let's move to the first topic, which is U.S. Treasury bonds or government bond rates. And we have a chart I want to show off the top, and this shows us all the rates. It's a pretty recent chart showing us 1 month rates, 4 month, all the way out to 30-year rates. You can see it here on the screen. And what you'll notice right away is that the shorter end of the curve, so the 1 month, 2 month, 3 month, is higher, paying higher interest than the 30-year, which is opposite of what you would normally see, right? And we talk about this as being an inverted yield curve when the short end is paying you more money than the long end. And so therefore, you ask the question, well, who's going to buy a longer term bond, let's say a 7-year US bond, when you could buy a 2-month bond and make almost 5.5%? So of course, this kind of plays around with investors and what they decide to do. But overall, make no mistake, as interest rates have moved higher in the US, the 10-year approaching 5%, I think it's around 4.8 today. The 30-year actually ticked above 5% recently. It's come back down below that. That's been a very, a negative sign for investors. Interest rate sensitive parts of the economy, interest rate sensitive sectors of the stock market, real estate. You're looking at utilities, which usually they don't grow an awful lot, these stocks, so they are bought for the dividend they produce. Now, of course, if they're paying only a 4 or 5% dividend, and you can make over 5% in a 30-year government treasury bill, why would you take the added risk? Which is what Brian said in our interview. So a lot of individual names, a lot of sectors of the market have been being sold off because people are just moving their money into the safe haven of the bond market, especially on the shorter end. So as we see interest rates rise, we are definitely seeing the stock market pull back. And I think individual investors need to take notice of that before you make your investment decisions. And we have another chart here, and it's probably the most important part of this chart is to the far right-hand side. And this is the 2 and 10-year treasury yields. And what you'll notice, this brownish, reddish part in the, all the way to the far right. And that tells you, or that shows you that the yield curve is inverted, that the 2-year is paying higher interest than the 10-year right now. Although we are definitely seeing that spread narrow, the 2-year now, at one point was 1% difference between the 2-year and the 10-year. Now you're looking at maybe 30 basis points, 40 basis points. So that spread has narrowed, and that tells us that the yield curve is hopefully getting out of this invertedness, if you want to call it. So hopefully things will get back to normal, where longer term bonds or GICs are paying higher interest than shorter term ones. And that would be more of a normal bond or normal bond market. Second point I wanted to make for individual investors before you make your investment decisions is to be patient and look for a change in tone for the markets or of the markets. And as I said earlier, October tends to be the month that things turn around. You come in after the worst month of the year, which is September, and you move into October, and what we usually see is after Canadian Thanksgiving, after say the first week of the month, we usually have Canadian Thanksgiving, and then somewhere around mid-month, you start to see things turn. And I have a chart here of the S&P 500. And you will notice that, just take a look at last year, we have it here kind of towards the right-hand side as well. Things really turned around in the month of October. We saw the market start to pick back up. We actually saw interest rates, or the increase of interest rates, start to slow down. And we hit the ground running as we moved into 2023. So at the end of 2022, October, we saw that turnaround, which we tend to see more often than not. If you go back, I guess, a few years, you'll notice that October 2021, the markets were continue to move higher as well. And even in 2020, coming out of, I guess, the difficult times of COVID, we see a turnaround in March, April. That was kind of the inflection point there. But even if you look at where October is in that chart, you'll still see that, or you will notice that the month of October was still a good month, where the markets came in lower and ended up higher, and November was higher as well. So overall, it's been I guess a time. October is a time where we see a turnaround. And I know you can't time markets. We talk about this all the time. You don't want to try and time markets, but you definitely want to look for a change in tone of the market. Perhaps we're seeing it already. And what I mean by that, well, we're seeing higher interest rates this week, as a matter of fact. And yet Monday, the NASDAQ was higher. And the NASDAQ is primarily tech stocks. Tech stocks trade on the NASDAQ. And we know tech stocks usually fall. They're interest rate sensitive when interest rates move higher. Today, before we did this show, interest rates were also still at relatively high levels, highest levels we've seen in 16 years. And yet the NASDAQ was higher as well. So perhaps that, I guess, sign that I'm looking for, that investors should be looking for, maybe that's one of them, that tech stocks kind of break away from that interest rate higher, tech stocks lower scenario. And now maybe we're starting to see a bit of a difference in tone. The market for tech stocks, for the NASDAQ, and maybe for the overall S&P is starting to change. So look for that change in tone of the markets. Our third point that I wanted to stress is something we talk about all the time on the show: corporate earnings. Corporate earnings obviously come out 4 times a year, and they're very crucial. And this time is no different. We're going to hear from the big bank CEOs out of the US. They kick off the earnings season. We'll hear from JP Morgan, Bank of America, and other US banks as well, Citibank. What are they saying about the economy? What are they saying about their individual companies, how they're doing themselves? Their shares will definitely reflect what they say. And I think the stock market may be influenced by what these CEOs are saying. Jamie Dimon, the CEO of JP Morgan, he's never hesitated to talk about or to tell us what he thinks is going on out there, give his views and his opinions, and they can at times move markets. One chart I have here, or a couple of charts I have actually. First one is Bank of America. You'll notice that Bank of America is trading at a new 52-week low. Yes, a new low for Bank of America. The dividend has gone up. It's now getting closer to that 4% mark. But if you notice on the far right how the stock has really tailed off, and Bank of America, obviously for those that can handle the risk, is something that I've looked at closely. JP Morgan, the next chart here, as I mentioned, biggest bank in the United States, one of the biggest banks in the world today, hasn't fallen as much as a Bank of America has, but still you've seen a tail off in their share price. So let's focus on what these CEOs, especially of the banks, say in the next 10 days or so. But after that, all the CEOs that come after them, bank CEOs, tech CEOs, and just industry in general. What are CEOs saying about their businesses? What can we glean from what they're saying about the economy? And I think that, combined with where interest rates are, I think that's going to be very important to give us a signal as to how you should be investing over the next couple of weeks.